Now that we've got a pretty good understanding of chart patterns, let's move into a different type of a pattern. And the type of pattern I'm talking about is what we call a gap. Now, a gap is a pattern of behavior, but it's different. Most of our patterns of behavior are what we would call a consolidation and a transition of sentiment. A gap is the exact opposite. A gap is a surge of sentiment. It's going to be a thrust in one specific direction. And yet, while it's a sudden surge of sentiment, it's also really indicative of what might happen in the future. Now, there's a lot of different types of gaps. So in this section, we're going to learn about different types of gaps and what you can expect with them. To start our discussion, let's learn about what a gap is. When the opening price of a stock does not match the previous day's close, it creates a gap in pricing. Take a look at my image over here and notice this particular candle closed where this arrow is. That's the closing price. And the next day we opened up here. The space in the middle is what we call a gap. Now that gap represents a void in trading behavior. Nobody traded at those prices. And now the question comes in, will the gap get filled or will the gap stay open and become what we call a true gap? And so that's what this section is really going to be about. But to simply define it, it's just when your closing price does not match your opening price of the next morning. So what would cause these sudden change in perceived values after the market is closed? Well, there's a lot of things. For example, it could be after hours trading. You realize that some markets do continue trading after the general market has closed, and that change in value, just the general trading after hours, could change the overall perception of the price of the stock for the next morning. That's one thing that could happen. We also have after hours news. This is probably going to be the bigger cause of a morning gap, where we've got news that comes out overnight. For example, maybe an earnings report came out overnight. That would oftentimes, more often than not, cause a gap the next morning as there's a new surge of information to change the perception of the value of that stock. So that would cause a gap. We've got a sudden emotion. Somehow, for whatever reason, there's a sudden emotion of desperation. It's probably going to be reflected as fear. Either fear of missing their opportunity or fear of losing their capital. But it's going to be reflected as fear. That's the emotion, and it becomes a desperate emotion. So people take what would really be probably classified as an irrational action. They go in and they buy suddenly, or they go in and they sell suddenly for no specific reason except for their own perception. And then what we get is we have a gap and we have a surge in emotion at that time. But at the end of the day, it really comes down to just an influx of overnight orders. You know, there can be all this emotional change, and if one or two people have it, it's one thing. But what if you have it across an entire cross-section? What if you've got an entire herd that suddenly has a different feeling about the trade? What's going to happen? We're going to have a surge in overnight orders as either buyers or sellers. And as we learned a few lessons ago, when we've got a surge in orders, buying and selling, it throws the supply and demand off, and the market maker has to go make the market. They've got to go match those buy and sell orders, and so they start moving the price, and before you know it, boom, we've got an overnight gap in price action. I want to do a little exercise with you and take a look at this screen and just kind of look at these candlesticks and ask yourself, where do you see a common opening gap? Now notice the terminology, common opening gap. And it's either going to be between A and B, B or C, C or D, D to E, or E to F, or F to G. So just look at that really fast and ask yourself, where do I see a gap in trading behavior? And I'm sure a lot of you are thinking, hey, I see a gap between D and E. And you would be totally correct. There is a gap. But the terminology that I was looking for was a common opening gap. Now, what is a common opening gap? There's another one on this chart. Let's look at it. And you notice this is between C and D. Take a look. C closed at this price and it opened down here at this price. And there is a gap in pricing that happened early in the morning. The void between the morning opening price and yesterday's closing price. This is what we call a common opening gap. And as the name suggests, they're very common. They happen frequently. They're very often occurring in the market. It does not in and of itself specifically mean a whole lot. And here's maybe the most important thing to recognize. They almost always fill during the day. A lot of day traders like to trade the common morning opening gaps because what will happen is they see them, they know that these gaps normally fill during the day, and so they're looking for those gaps early in the morning, and then they'll trade as a contrary trade, and they are trying to scalp the difference in that gap action that will happen early in the morning. Again, that's a normal activity daily. It's very common. It happens across a lot of stocks. Here's what you need to know. As a trader, it's good to know that most gaps will fill during the day. Most gaps. But do not let that word most make you think that it's all. One of the biggest misconceptions I hear is that people think that all gaps always fill, and it's not a true statement. In fact, there's another classification of gaps that we call true gaps that don't fill, and they are very, very important, and they create a whole new classification of patterns, and that's what we're going to learn about right now.